Welcome back. I'm Michael Bull, and this is the Commercial Real Estate Show. We have some great shows coming up for you. Next week, we'll cover the hospitality sector, and the week after that, we'll look at architecture and design. Be sure to catch shows of special interest to you. Sign up for a once-a-week email announcing the show topic at commercialrealestateshow.com. Well, today we're discussing industrial real estate. Please welcome my next guest, Scott Seeley, Chairman, Seeley & Company, an investment and operating company acquiring, developing, and redeveloping regional distribution, warehouse, industrial flex, and other industrial properties located primarily in the southeastern, south central, and southwestern U.S. Mr. Seeley, thanks for joining us today.
Thanks for having me. I'm glad I'm here.
Well, we appreciate it. And, you know, you have a lot of properties around the country, and you guys are on the firing line with these properties. And so what do you see for occupancy and tenant demand in your properties today?
Well, today, in reflecting on 13, we really began to see an improvement in the market in 2012. But in 13, our overall portfolio grew in occupancy by about 900 basis points. That looks like that's going to continue. We're at about 90% today. And it started really in the middle of the country and moved east. And it's a very encouraging sign the way the market is moving.
And how does that compare to say, over the last 10 years or so? What's the trend there?
Well, the trend, I believe, is that the bigger spaces started leasing early, and then the smaller spaces started leasing, and typically what we saw before was the larger spaces lagged a little bit behind the smaller spaces in the recovery.
Okay. And in the larger spaces, is that because of the .com and the online sales that these larger spaces had leased up faster?
I think it was the availability of credit. The larger national companies with corporate credit had the ability to realize the recovery sooner, and they were able to use their business plans and expand, whereas the smaller companies, it took longer for the credit availability to reach them, and they've just began to participate in the market in 13.
And that's a big part of it, isn't it? If these companies can get financing, then they can expand and they can grow, right?
That's true.
Yeah. And what about the residential housing market? Are you seeing some of the smaller and regional and local tenants, are some of those coming back from the housing recovery now? Are you seeing any of that?
E-commerce and housing are both driving a good portion of the industrial recovery. Mm-hmm. E-commerce, I think, accounted for almost 50% of the new build-to-suit development that went on. Housing followed that somewhat a little bit later, but those two are the biggest drivers. But overall, it's really a broad increase in activity across all sectors.
Well, that's great. And where can a tenant maybe get the best deal right now, where there's the most opportunities to get space? And then on the other side of the coin, which markets are really tight right now?
The best deals probably are still in Florida and Atlanta. Mm-hmm. And perhaps Nashville. The strongest markets for us are in Phoenix, Dallas, and Houston.
Yeah. And you're headquartered in Dallas?
We are in Dallas, yes.
Okay. And we're on the Dallas radio here, so
well,
say
good.
Hello, right?
Hello, everybody.
Say hello to the family, right? What are the industries and the type of tenants that you're seeing more activity from right now?
In the larger spaces that are available, we're seeing more in the home building industry and service providers to that industry. And generally, the smaller tenants are really just growing companies that are in all sorts of businesses.
Okay. Well, that's good. So it's really broad-based then.
Broad-based.
What do you see for trends related to lease packages and incentives that these tenants are able to negotiate in some of these markets?
Well, Michael, it's really all across the board. When you look at in Dallas and Houston and that market in the central part of the country, it's probably a year ahead of, say, an Atlanta or Jacksonville market. So what we're seeing happening in the leading markets is more of a contraction of the free rent. So maybe free rent is down roughly 50% as 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 a package going out to a tenant.
Mm-hmm.
On the TI package, it's probably shrunk about 30%. And in fact, I think rents are up 5 to 10% on an overall basis. But in the slower markets, the ones that are now in significant recovery, it's a little bit less robust than that today.
Yeah. Well, I think some of these tenants may be getting some rate shock then in some of these markets, right?
I think that could be the case.
Yeah.
We do think that rental rate growth could be 5, 6, 7% a year for a few years.
Well, that's good news for the market and good news for the economy. And, well, we're going to take a short break here. When we get back, we're going to talk more about some tenant strategies and landlord strategies for space, and we're going to look at the investment market a little bit. I'm Michael Bull. This is the Commercial Real Estate Show. We'll be right back. The Commercial Real Estate Show is brought to you in part by your friends at Bull Realty. When your business requires proven performance, visit bullrealty.com or call 800-408-BULL. Welcome back. I'm Michael Bull, and this is the Commercial Real Estate Show. You're invited to check out the Commercial Real Estate Show on YouTube. That's right. If you're listening to the show on one of the 12 radio stations around the country on the podcast, a lot of our shows are on video. You'll find a great selection like Reese on Real Estate and the Fed's View on commercial real estate. You're invited to subscribe to the channel so you don't miss a show of special interest to you. Just visit YouTube and search for the channel Commercial Real Estate Show. Well, today we're discussing industrial real estate with Scott Seeley with Seeley and Company. And Scott, you said you're getting more demand from some of these smaller tenants. Where's that demand coming from? Why are they growing?
Well, that's a good question. I think tenant demand is really coming from the certainty of the business climate today, the jobs growth that's taking place in the marketplace, the availability of credit. That's primarily the reasons.
Okay, yeah, that makes sense. And everything's clicking a little more cylinders today. Well, what about some of the trends that you see in build outs and ceiling heights and truck courts and LEED certified buildings? What do you see on build out? Anything any different today than you've seen in the past?
Well, in the supply chain, the warehouse properties are significantly more valuable to the companies that are using the supply chain in their business. There's more going on in the warehouse than there used to be. So yes, there is a little more requirement for office space. There is a need for additional parking in the bigger structures and bigger properties where it's more logistics oriented, a lot more trailer parking, a lot more fiber optics, all kinds of things that go into adding to the value of the supply chain that's going on, the activity in there. But basically, I think it does get back to they want a stable landlord, they want a good, tight, waterproof roof, and they want good, efficient mechanical systems, which now you're seeing more LEED certified buildings, and that's all part of that.
Right. What about ceiling heights? What's the norm today in a new building?
Everybody wants a taller ceiling height, but they don't really use them as much. So sure, if you have a logistics center that's really dependent upon a very expensive racking system, that's true. But typically in tenants of 20 to 75, 100,000 feet, they may not have the same stacking requirements that much larger spaces are. So we haven't seen a tremendous change. Maybe 24-foot clear ceilings are really a minimum, but it's not necessary that everybody needs 32 clear.
Okay, and you get to see a lot of these tenants' logistics needs and their operational efficiencies. Do you have a tip if we've got a tenant out there, a tip for operations or efficiencies and logistics?
Well, I believe in all of those cases, what they're looking for is the right business environment. So if they're in locations that provide the ancillary services of shipping capacity, good fiber optics, good utilities, constant power, that's really what they're looking for.
Yeah. So anything that a tenant sometimes might overlook that that later they find is real important, and the location that they choose and the building that they pick?
Maybe the efficiencies of the lighting systems and some of those kind of things, but probably more importantly, are their taxes, the ad valorem taxes on the building as competitive as they could be? The common area costs that are incurred by that building, are they equal to competitive spaces, or are they 5 to 20% less than they may incur in an alternative location?
Okay, well, those are some good tips. And let's change our discussion a little bit here to the capital markets. What do you see for investor demand in cap rates for some of the stable, high credit type of properties?
Well, in the primary markets, I believe all the cap rates are somewhat stable, but in the primary markets, they probably have a little room to maybe decline slightly. I think in the secondary markets and less than the core markets, you may see a cap rate compression of another 50 to 100 basis points over the next year. It's a very competitive market with capital. There's a lot of demand for industrial investments. Allocations of industrial by institutions is lower than they like for it to see in their portfolio. So there's a growing demand for invested capital in the industrial sector. So I don't see cap rates going up until interest rates go up maybe 50 to 100 basis points.
Yeah, and that's interesting. And then, some investors will look at some of these lower cap rates and think, wow, I might have some sell side risk because interest rates may go up, so cap rates may go up a little. But as you're sharing with us today, you have a lot of rental increases, some rate increases that you still could make a nice profit when you resell this property, right?
I think that's right. The trough typically in the industrial market lasts about 18 months in a recession. With this one at 4 years, there are a number of properties that you can buy, income producing assets that were leased in the trough of the market in the recession, and so there's significant growth that way. Then there's also just significant growth, we think, as rents move to some percentage of replacement costs of the assets. So it's a good market where we would expect to see 3, 4, 5, 6, 7% rental increases a year for the next few years.
Wow, that's amazing, and it really makes industrial a large appetite from investors for the industrial market. Well, we're going to have more on the industrial investment market and a few more tips for you. I'm Michael Bull. This is the Commercial Real Estate Show. We'll be right back. The Commercial Real Estate Show is brought to you in part by France Media. France Media provides exposure to the world of commercial real estate. Visit francemediainc.com or call 404-832-8262. Welcome back. I'm Michael Bull, and this is the Commercial Real Estate Show, where we always like to have fun. Where we're excited to announce a new service on the show. It's called Ask Michael Bull. Every business day, I answer a listener's question on video. You can check it out at the Twitter account, Ask Michael Bull, or on our YouTube channel, Commercial Real Estate Show. Well, today we're discussing the industrial market with Scott Seeley with Seeley & Company. And Scott, we talked a little bit about cap rates. So on these high credit tenant properties, these core assets, you see cap rates running in the 6 to 7 range?
6 to 7% in significant markets where there is some lease term and the credit's good and it's a newer property. And then it graduates, I think, as you move to more of a secondary market to 7 to 8% cap rates, but overall, people are trying to I think achieve a yield that's somewhere in the 7 to 8 to 9% overall on unleveraged return, and that's those are still very attractive cap rates.
Okay, yeah, they are, especially when you look at how low interest rates are right now and the safety that the industrial seems to have. But what about some of the properties that have a little lease-up risk or have some renewal risk? Are there some opportunities there, and what differences in cap rates do you see typically there?
Well, I think that's where the opportunities are in A and B assets, where you do have some lease momentum and NOI growth that's potentially going to take place there. In those properties, there's probably 100 to 150 basis point premium that you'll receive in return, just because they are multi-tenant typically. They may have some current vacancy, or they may have some future vacancy over the next year to 3 years through rollover or whatever. So that's really, from our perspective, you're able to buy those properties at discounts to replacement costs. You're able to enhance your return, and we think still mitigate risk.
Okay, and you guys at Sealy and Company are active buyers, and so if a listener has a particular property they may want to bring to you, what type of property should they bring to you to possibly for you to acquire?
We like vacant or leased assets or partially leased buildings. In primary markets, we like to buy A and B properties. Typically sizes would be a $5 to $25, $40 million investment size. In secondary markets, we prefer Class A or Class A minus industrial buildings in good business parks with all the amenities for distribution.
Okay, and we talked about how strong the industrial market is right now. What do lenders think of the industrial market on the financing side, and how do they look at these value add or lease issued properties compared to these core assets?
The institutions are interested in making loans on industrial properties. The appetite for lending is way up, particularly since the last 2 quarters. But I believe that they still don't want to give you a whole lot of credit for vacancy. They will give you they'll make the loans more attractive by giving you maybe another advance if you achieve your leasing success. They are making much more flexible terms than I think has been traditional in the market. So they're trying to work with you, but they're not going to lend more money than the pro forma and their expectations and their guidelines of their loan limits.
Typical loan to value ratios?
We're seeing anywhere from 60 to 75%.
Okay. Scott, thanks for joining us today. We appreciate it.
Thanks for having me.
If you'd like more information from Sealy & Company, visit SealyNet.com. That's SealyNet, SealyNet.com. Well, I have a question for you as a listener. Can you join us next week? Well, I hope so. We'll be talking about the hospitality market. You don't want to miss that. So thanks for joining us today. I'm Michael Bull. Until next week, be sure that you always lead, learn, and laugh, and join us for the Commercial Real Estate Show. The Commercial Real Estate Show is brought to you by Atlanta Office Liquidators, new and used furniture liquidators, France Media, publications and conferences, and Bull Realty Commercial Brokerage, a great place to do business. For more information on these companies or to access additional podcasts, videos, or blogs, visit commercialrealestateshow.com.